There's some risk inherent with this. And the risk is that the charity's in existence to make the payments back to the donor. You as charities also have to remember that you have an obligation and a risk that you have to make sure that you manage these properly so that you make those payments back. Because you don't want to be in front of Detroit Free Press saying, charity missed gift annuity payments. That would be very bad to your reputation and actually bad for the retired field, because then everybody else would have difficulty being able to sell gift annuities. Okay? That is the whole concept of being a general creditor. So when someone sets up a gift annuity with a charity, they are a general creditor just like the light bill, the rent, and everything else, because there's not an underlying trust to support that gift. It's also not insurance, and it's not a security product. We're going to explain a couple of specific federal tax rules regarding that. But I would also tell you that it's extremely popular here. I would say in our shop, about 80% of our plan gifts are charitable gift annuities. So to the extent that you can do this, because they're simple, because they're easy to understand, they're very, very, very popular. Per the Internal Revenue Code, there are two types of charitable gift annuities. There are immediate, which means as soon as I give the gifts, within the first quarter or so, I'm going to start getting an income stream back. And deferreds. Deferreds are, I want to start getting the payments, let's say, when I'm 65 and I'm retiring, or 68, or whenever I decide to retire. Those are the two that are recognized under tax code. You will frequently hear conversations about two others. One's a college option. This was invented by people at Harvard. We basically put in a provision that says, here's my payment stream, but I have the option at a certain time, typically when the child is leaving to go to Harvard, to accelerate all the payments into a 4-year or 5-year period of time to be used for income to pay tuition to Harvard. Okay? That was approved by a private letter ruling, and then a variable. And the variable is where you basically have annuity payments that kind of step up in value over time. Both of these are by letter ruling. Why I mention them is, for those of you who are not lawyers or accountants, private letter rulings are not controlling on the general population. They are controlling to that specific taxpayer. So if you ever decide that you want to be able to offer a college or a variable option, what you need to do is say, I should probably get a private letter ruling to get those approved as being issued by my charity, because you cannot rely on these previous rulings. They're probative in nature, they are not controlling. Okay, IRS Code 514C5 defines what a gift annuity is. Gift annuity provides or requires that the only thing that you're going to get back in exchange for the gift is the annuity stream. That's one of the requirements. So you can't say, I'm going to give you this plus this plus something else. It has to be the only thing. The present value of the gift annuity has to be 90% or less. So in other words, what I'm retaining back has to be 90% or less of the total value. If the slice that's going off to charity is worth less than 10% of the total value of the gift, it is not a qualified gift annuity. It becomes a commercial annuity. So there has to be at least a 10% tax deduction. That's what that boils down to. All right? And the other thing is it can only be payable for two people who are living at the time the annuity is issued. So you can't do this for me and my spouse and then my children. Wrong. Two people, okay, who are alive now. You can't say for me and then my to-be-born grandchild. No. They have to be alive at the time. Typically, I will tell you that these are usually set up for husbands and wives, but they don't have to. They can be set up for you and your spouse or child, or for your children. Okay, we'll give you some examples of that. There can be no guaranteed minimum amount of payments that you're going to receive. And then the last thing is this basis allocation. Go back to the watermelon. This is Section 72 of the Internal Revenue Code. You literally take the basis in the property contributed, black line, and you divide it, you allocate it under 72 to that portion that's passing to charity and that portion that's being retained back by the donor. And then based on their life expectancy, they give part of that tax-free portion at basis each year over their expected life expectancy based on the mortality tables. Fun thing about gift annuities, most of the annuitants that set up charitable gift annuities live longer than the life tables by about 2 years. So you want to live longer, buy a gift annuity. Okay? That's okay. And the rationale there, what actually that is that a lot of people are doing this are a little more sophisticated, they have better wealth, they have better insurance, therefore they live up longer than the general population. But we use the mortality tables established for the general populations. Okay? but it's a good sell point, you know. I get to know. Again, it's an agreement between the donor and charity. There is a mandatory disclosure that you have to provide. This gets into some tax rules. Does anybody remember the old gift annuity case that involved Texas? Okay, situation. Woman in Texas starts buying really big charitable gift annuities. And what we use, and we'll discuss, is there's a group called the American Council on Gift Annuities that sets the recommended maximum payout on charitable gift annuities. I always describe it as the process that once a year they get together, they get in a room, they look at all sorts of factors, smoke comes out of the chimney, and the next thing you know, they set the rates for the year. Okay. But most charities use those. Well, what happened is when this woman died, one of her nieces decided that by using the American Council on Gift Annuity rates, that we all were in violation of antitrust price fixing rules. And she sued. That got all the way to the federal government, and the federal government said, no, 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 no. These are not commercial annuities. These are not securities. These are a charitable gift. And so they passed these laws that say that if you do the proper disclosures at the time the annuity is established, then it is excluded from the antitrust rules. You don't provide these, you're in violation of antitrust and price fixing. You're in violation of security rules, you're in violation of insurance rules, and you also have to look at each state as to what they require, depending on the states that you're in. So that's why we get that annoying little disclosure statement. This is why, because of the antitrust case out of Texas, okay, from about 25 years ago, where it was passed, 1995, okay? Typically, gift annuities are cash or marketable securities, but you can use other assets. The challenge with other assets, you get real estate with that. Watermelon farm, maybe that's the best example. Maybe it should be stock in a watermelon farm. Is that you then have to figure out how you're going to make those annuity payments. If you got real estate and you as a charity have to sell it before you can make the annuity payments, how do you do that? You have to make the payments out of something else. So it's not that you can't do it, it just adds some practical aspects to it. The charity has to agree to pay the donor or beneficiaries, no more than two, the annuity for life. And if all these things comply, then you can get this tax deduction immediately upon establishing the annuity. Okay? That's out of the tax code and some of the other federal regulations. The thing that I should let you know too about this is that you can't do it for a fixed number of years. So you can say an annuity for a period of time. That's why those PLRs came out for more the college of the option and stuff. Is to say that in essence what they're doing is taking their lifetime stream and accelerating into a 4-year period. And that's why those came up. Okay. Typically the amount that goes to the charity is typically, in most charities, given to the charity for charitable purposes at the end of the annuitant's life, or as like we say at the Community Foundation, when the gift matures. But when your annuitants pass away, that's usually when most charities will pass that money along. However, all of the watermelon, when given to the charity, is available to the charity immediately for use. So someone could set up a gift annuity where you get this whole thing and start spending it tomorrow on operations. He just has to remember, you know, next year I got to pay them some annuities. I better make sure I have some other assets coming in. I don't think that that's a very conservative and appropriate way to do it because you're running the risk that you have the cash flow in future years. So what a lot of charities will do is put at least the portion that was the retained income stream in a reserve account invested to make sure they have the annuity payments. Our shop, we put the whole thing aside and use it as a reserve so that we can make sure we make those payments, and then we use it to charitable purposes when the gift finally matures. Sometimes there's a combination, but that's the way to do it. The other thing you have to think of, and we'll talk about that, is how do you invest these in the meantime. And then what happens, another reason why a lot of these are appreciated and very popular, is that from a donor standpoint, I don't have to go out and set up a big trust agreement. I don't have to file an annual tax return. I don't have to do all those type of things. Find a trustee. What happens is usually a 2- or 3-page agreement. Donor signs it after the advice of legal and tax counsel. And then what they do is they get a 1099 every year. You know, the charity issues a 1099. They just, like any other interest statement, they just publish it on their 1040 and they're done. You don't have to worry about getting a Schedule K-1 prepared and all those things off of the charitable trust. So it's a very easily administered program. Going back for a minute, American Council of Gift Annuities. This is their website. Establishes these rates. These are the recommended maximum rate based on certain factors. And they look at things such as what the commercial annuities are paying, what the cost of inflation is, what a typical asset allocation strategy is for using them, investing this in the long term. All of these things and a 1% administrative fee to establish the payout rate. Okay? Currently, these are the rates in effect as of this year. So if you're age 60, single gift annuity, it's a 4.4% payout. Going up to age 90 and more, you get 9%. How many people here on a CD are getting 9% a year? Okay? This becomes very popular. Okay? Marital deduction. I'm going to mention this because, again, most of these are done between spouses. Typically, when you do that, you are going to get a marital deduction for gift tax purposes for the portion that your spouse is also getting. All right? Because they're getting what's called a qualified income interest in the annuity. For those that are, you guys are advising people that are setting these up, you have to be aware of the fact that if I do it instead, money that I'm putting into the gift annuity, and I say it's going to be payable to me, and when I pass away, then payable to my wife, all of a sudden now we got a marital tax deduction issue for gift tax purposes because now that's a deferred gift to my wife. It's not an immediate present. And so I have to do some other little things in my agreement, usually reserving the right to cancel her interest up till my death, to not make that a gift taxable transfer when the day I established the annuity. Just had this conversation with one of my donors because they wanted to do that. We said, share it with her now. Okay, so then we're all set. And then that takes away the issue. But if they had signed the contract the other way, they would have had to use some of their gift tax exemption to protect what they were giving to their spouse. We would want to do that. Okay. Children and others, you have the same issue. If the child is going to be the immediate beneficiary of the gift annuity, then it qualifies as a present interest, and you can use the annual exclusion for gift tax purposes of the passive property to your children or to somebody else's children. If you defer it, then you get back into the same thing. All right? And then also generation skipping transfer tax. This is considered, if you're giving it to other people other than you and your spouse, then it is a gift just like any other gift. And if you're going to somebody that's more than a generation younger than you, 25 years I believe it is, it's not the lineal descendant, that it's generation skipping. You have to allocate generation skipping exemption. So these are things that you have to keep in mind once you get past doing it with just the spouse. Spouses are typically easy.